Hello and welcome to a special episode of Crossing Borders with Nathan Lustig, where I normally have conversations with entrepreneurs doing business across borders and the people who support them, with a special focus on those with a connection to Latin America. My guest last week in episode 63 was Komal, a Chilean entrepreneur who is the founder of Lab4U, a Chilean startup that helps kids learn science by using their smartphones. One of Kamal's conditions of doing the podcast was being able to turn the mic around on me and ask me the questions she's wished she'd been able to ask a venture capitalist, but hasn't been able to do so previously. I interspersed some more commentary into this podcast, as many of you have asked additional questions on how we evaluate startups, founders, teams for investment, and how the decision-making actually works behind the scenes at Magma. If you want to hear my backstory, my bio, and how a gringo from Wisconsin ended up co-founding Magma Partners, a Latin America-focused venture capital fund, listen to episode 38. If you want the nitty-gritty, listen to this hybrid episode with Kamal's questions and some of the things that I get asked most frequently. I hope you enjoyed this episode of Crossing Borders, this time with Lab4U's Komal Dadlani asking the questions. Before we jump into Kamal's question, the number one question that I get on social media, on LinkedIn, on Facebook, on email is, how can I get in touch with you? It's sometimes a confounding question because if you're asking me on social media or on a private message or on email, you actually are in touch with me. I know that you're probably asking, how can I get a meeting or how can I do a phone call? But the best way to get in touch with me and Magma is through our website. So we accept applications all year round, 24/7, 365, from our online form at magmapartners.com/apply. The form's in English and Spanish, and we're just looking for bullet points. We don't want you to spend more than 5 and maximum 10 minutes on it. Even if you don't fit our investment thesis and you're not even looking for money, feel free to fill out the form. Check the box looking for feedback, and we'd be happy to give you advice and our opinion, no matter what. We want to be helpful, even if your business isn't a fit. So why do we insist on the online form? Our goal is to get an idea of who you are, where you stand, and whether this makes sense for Magma and for you. The last thing we want to do is waste your time, so we ask that you fill out the form. We also believe that having an online form democratizes access to venture capital. Latin America is a classist, racist, and difficult to access the gatekeeper region. It's even harder than than in the United States. So we believe that having a form where you don't need an introduction, you don't need to know someone, and you can just fill it out and let your idea and traction do the talking is the best way to do it. So now that you filled out the form, what happened next? We get about 2,000 applications last year. It's probably going to be 2,500 or 3,000 in 2018. And they came from more than 20 countries around the world, including some that aren't even in Latin America. Our biggest countries are Mexico, Colombia, Argentina, and Chile, but we do get a decent percentage from Brazil as well. Every single application gets looked at by a partner to start. We'll review it and either reject it, ask questions, or set up a call. Why do we reject companies? Many times it's because it's out of thesis. Other times because it's too far along. Sometimes it's because we don't think we can help or don't know the niche. Other times it's even because you're spending too much money or you've raised too much before us. Don't be afraid of applying. We're always looking to help, and we're always happy to do it. If we see there's a potential fit for your business, we'll reach out and set up a call. After the call, we'll likely send more questions via email and then do a follow-up call or an in-person meeting, depending where you're located. In 2018, we've only met 50% of the founders we actually invested into in person before investing at seed stage. So don't worry if we haven't met in person. It doesn't matter. If we decide to invest, we'll send a clear email with the offer. Most investments take 2 to 3 weeks to get a verbal or an email agreement, and then another 2 to 4 weeks of due diligence and paperwork. We pride ourselves on being one of the fastest, if not the fastest, investors in Latin America. So what happens if we actually reject the company? Please stay in touch, even if it's out of thesis. If we can help with anything else other than money, please ask, and we'll do our best to help. Put us on your quarterly email updates, and don't be afraid to ask. We read most of the investor updates that come our way, even from our non-portfolio companies. We have a significant number of investors, both in Latin America, the US, and in Asia, who are always on the lookout and ask us for deal flow when we can potentially forward them investments that might not fit our thesis, but do fit theirs. Always make sure to respond when we say no. Close that circle, because it really makes sense for you to leave a good impression with us and us to leave a good impression with you, because we're always looking, and there's many times that maybe this idea didn't work, but the next idea will be one that does fit our thesis, where we do are able to help. So it's always good practice to close that circle with investors, advisors, anyone you reach out to. So without further ado, let's jump into my conversation with Komal. There's going to be a few times where I jump in again and insert some questions that got asked online. So hopefully this format works. Thanks again for listening.
Hello everyone, we are here today with Nathan Lustig, Managing Partner from Magma Partners, and this is Komal, CEO and co-founder at Lab4U. I'm very honored to be sitting next to Nathan, where we are going to talk a little bit about him and his fund, Magma Partners. Thank you very much for this evening.
Of course. One of your conditions for doing the podcast for you was that you had to do the interview for me. So what's fair is fair.
Of course. I like learning, and this is a great opportunity for me to learn, and probably all our listeners who are going to learn from you.
I hope so.
Yeah. So, Nate, I've known you for a couple of years. You've been a very silent investor. It's not common or often that we read about you in the Chilean newspapers, but whenever you do something, you do it quite well. I've seen great things about you, your team, your fund, and I think it's time for you to share a little bit about your knowledge with the viewers. So I would like to start asking, you were an entrepreneur and you went from entrepreneur to investor. Tell me briefly about that transition, and what did you learn as an entrepreneur that made you an investor?
I had started 2 different businesses when I was in university. The second of which brought me to Chile with Startup Chile. And we ended up with my different business partners, we ended up selling both of them. And when I came back to Chile in 2012, I worked at a Chilean startup and then ended up teaching a entrepreneurship class, which was called How to Build a Startup. And it was the class that I wished I'd had before I'd started my startup. And it was actually an extension of back in the pilot round of Startup Chile. They didn't have points. They didn't have give back. They just said, you're getting taxpayer money. You'd better do something nice for us.
Yeah.
So it was like about 6 or 7 of us created a class, very basic, where we were going to do speaking. And we actually got a mining company in Antofagasta to pay us to fly up to teach at Católica del Norte in Antofagasta to teach the class. And it was great. We loved it. The students loved it. It was open to the community, not just students. And when I came back to Chile in 2012, another friend of mine and I talked to a professor from Católica in Santiago, and he said, well, why don't you teach that class here? I'd love for you guys to do that. So we created the first accelerator class where you had to come with an idea and build a product and demo day at the end.
Those crazy Americans teaching Chileans how to build a startup, right?
So it was actually in the one in Antofagasta, it was 2 from the US, 1 Chilean, 2 Portuguese, 1 from the UK. And so it was just a bunch of crazy random people in Antofagasta. And then when we did the one in Universidad Católica, it was a Chilean and me that we were both in Startup Chile.
Okay, awesome. Can you summarize a little bit about starting Magma and your investment thesis for Magma 1?
So one of the things that happened was when I was teaching that class, we had students that actually launched businesses. It was real businesses.
Awesome.
And actually a couple of them are still around today. There's one called WebDocs, which was in the second semester that we taught it, that's gone on to raise millions of dollars and has, I think, probably 50, 60 employees, clients across Latin America, that came out of our class. And so during that class, real businesses happened, and people would say, well, now what do? I finished the class. Can you still help me, or can you connect me to the right people? And so I was doing some mentorship. I was also in between things, so I was consulting for Startup Chile. Some friends and I launched some e-commerce businesses just to test it out. And realized after maybe a year that I was doing everything that an investor did except the important part of investing money. And when I was in Startup Chile, I had met pretty much every investor in the local ecosystem. And it wasn't that great. There's a lot of well-meaning people, but they didn't have operational experience, or they were structuring deals where they were going to get 49% of the business for $50,000.
Very crazy.
And they could buy the other 2% to get them to 51 for like another 100,000. Like crazy sort of deals. And so I created the plan sort of like I had for the class that I wish I'd had, the fund that I wish I'd been able to meet. And I just wrote it up and I said to a couple of different friends, hey, I've thought about doing this. And serendipity hit with Diego Filippi, who was part of the original Startup Chile team, gave me a call and he said, hey, there's this guy, Francisco Sainz. He's got a family office and he's interested in diversifying into tech and also giving a hand to the next generation of entrepreneurs. So remember meeting up in the as conservative can be Club de Golf in Santiago with Diego and Francisco, and we pitched him the idea. And shockingly enough, because Chile is massively conservative, he said, this is super interesting, send me a written proposal. So I made the proposal, sent it to Francisco, and a week later he said, let's meet again. So we met up again and he said, I want to do it. How much do you want as a salary? And I said, no, I want to be a partner on this. This is going to be something that we can work together on. And again, shockingly, because most of the time in Chile, conservative families want to control the whole thing, he said, okay, go for it. So I put in a little bit of money, as did Diego. Francisco put up the vast majority. And that was the start of Magma. You were asking about Magma One's investment thesis and some of the things that we've learned.
So I'm going to break in again here to answer a question that we get fairly often online. What did Magma 1 invest in and how has it changed as you've raised Magma 2? So I've talked a little bit about already what Magma 1 invested in. We started in Chile. We invested in fintech, insurance tech, and B2B companies that did business in Latin America, while also investing in companies that had their tech and sales teams in Latin America but attacked the U.S. market. We invested in 32 companies, of which more than 50% were based in Chile. But we also invested in companies that had founders from Venezuela, Argentina, Colombia, Mexico, Costa Rica, and the U.S. And many of our companies were already doing business in Colombia and Mexico and the U.S. especially by 2016, 2017. In the last year of Magma 1, which is 2017, we already had operations in Chile, Colombia, Mexico, U.S., and China. In Magma 2, which we launched in January of 2018, we focused on basically the same thesis, but narrowed down to fintechs and insurance techs that operate in Latin America and companies that have their tech and sales teams in LATAM but target the U.S. market. Geographically is where we've had a big change. We've continued to expand all over Latin America, with the focus especially on Colombia and Mexico. Of the 16 investments we've made in 2018 out of Magma 2, including follow-ons that came from Magma 1 companies, 3 have been from Colombia, 3 from Mexico, 3 from Chile, 2 from the US, 2 from Ecuador, 1 from Peru, 1 from Puerto Rico, and 1 from Argentina. But that doesn't tell the full story. The 3 that we invested in from Chile include one that's based in Miami and one that has it's based in Chile but already has operations and most of its revenue from Mexico, Brazil, Argentina, and Peru. They use Chile as a base. In Mexico, one of our most interesting companies is a company that started in Silicon Valley but opened up a dev office in Guadalajara. We also have our first investments in Peru and Ecuador. The company that's based in Puerto Rico was the first Puerto Rican company to get into Y Combinator. That's called BrainHigh. And our Argentina company is based between Argentina and Silicon Valley, Podcast App, and is also a Y Combinator alum. So as you can see, while we may have a reputation for being Chile-focused, and we did get our start in Chile, and most of our money comes from Chile, in fact, we are actually region-wide, and we love to see founders from all over the region. And over the last year, we've gotten, I think, about 2,500 applications, with the top countries being Mexico, Colombia, and Chile. I'm going to jump back into Komal's question about our study and what we've learned from investing in Magma 1 that we're pulling into our investments in Magma 2. We recently did a study of the first portfolio, and we plotted dates, amounts, times, all that stuff onto a graph.
And can you tell me what have you learned in that? What have you done in Magma 1 that you've learned? And are you applying those lessons learned for your Magma 2 fund?
We're definitely applying the lessons learned. With Magma 1, we started investing just in Chile, and then in two niches. So we started investing in B2B companies that did business in Latin America, and then companies that had their tech and sales teams in Latin America but went to the US. And we quickly invested in the first year, we invested in, I think, about 14 companies. And I think it was a Brad Feld quote from Foundry who said, everybody makes an investment thesis and then immediately breaks it. And we did that. So I definitely agree with him that that's what happened. So we had a very specific investment thesis, amounts, types of companies, stage, and then we got excited about stuff.
Right. But did you benchmark from other venture capital funds in the US, or did you come up with your own investment thesis?
So we benchmarked the stages and we benchmarked the types of terms that we would offer, but we did come up with our own idea of what we should be investing in and why.
Okay.
And so we started investing, and when we look back on it recently, we saw that our first investment was really good. That ended up being Propiedad Fácil at the time, which is now Property Simple. Adrian Fisher, with I think the second episode of this podcast, he's now in the US. He's raised $3.5 million and is doing really, really well. But after that, the next year of investments were investments that were not so great. And there's probably 80% of them that, knowing what I know now, we wouldn't have invested, and not just because of the business itself.
Tell me more about it. Can you tell me what have you learned, and give me some examples?
So one of the worst ones was a company that looked great from the outside. We did some basic due diligence and it still looked good, but we weren't sure about the people.
So your stomach was not sure.
Yeah, we're like, this looks good, but there could be something weird here. But it looked really good, and it was something we could help with. So we did the deal. A year later, they started asking for the next chunk. And we said, well, show us any numbers. We want to give you the money, but show us the stuff. And they just went dark. And we didn't hear anything for a long time. And then finally, they came back, and one of the business partners' family members was basically stealing from the company.
No way.
And it was something that we probably couldn't have seen unless we did a deeper due diligence.
With financials.
On the family itself, yeah.
Or financials, like income statement, balance sheet, where's this money coming from,
the money in the company was okay at the beginning. It was the fact that as the company grew, they were taking more and more out the back and not leaving it in the company. So, one, better reporting and staying on top of them.
Yeah. 2,
better due diligence in the beginning. 3, probably listening to gut more.
Yeah.
Generally, when people argue too much over terms and valuation, it's usually a bad sign. Not saying that you should give away your equity in your company. You want to get what's fair for you, but when you have somebody who's arguing over insignificant points because they don't know or because they want to win that one point, it hasn't been a good experience for us. We've had third-party, I wouldn't call them consultants, but people who've been brought on the team that are knowledgeable in raising money. We've had a couple of companies like that, and it hasn't worked.
So, the founders who bring in fundraisers, and for them to do the fundraising for them.
Yeah, where they say, okay, I'm an experienced person, I'm going to come in and I'm going to be a quote-unquote founder, and they're the ones leading the investment process.
Yeah.
That hasn't worked well. We did a deal or two like that where that person ends up leaving the company 6 months later,
right?
And that didn't go. A more controversial one, or maybe not so controversial, is that the best entrepreneurs we've found and invested in are people that are not in the wealthiest segment of society, but the next level down. So that had a good enough education and good parental support, and maybe they studied abroad for a little bit, or had influence in learning foreign languages, but they still have that kind of chip on their shoulder that they want to go out and succeed. We've also seen, I think we started funding older entrepreneurs the farther we got along. Some of our best entrepreneurs are very young as well, but some of the best ones are mid to late 30s, early 40s, and have had some failures under their belt or some moderate successes under their belt. We've also learned that you basically can't change a founder. We invested in a company that is still really, really good in terms of all of their metrics except for making money. And it's one of those ones that if you just said, if I would go in and operate that company, could sell 50 times more in 6 months. But you just can't, the old saying, you can lead a horse to water, but you can't make it drink.
Right.
You can't do that with startups. It doesn't work. So we've learned lots and lots of things.
Wow. These are great insights that you have from your previous investments. If you have entrepreneurs reading the blog and listening to the podcast, can I ask you that famous question? What do you look in entrepreneurs or in companies when you're investing, especially now with your Magma 2 fund?
So we like to see entrepreneurs that are taking a risk. So that doesn't mean that they have to have no salary or such a low salary that they're just eating ramen all day. But we want to see them not being paid the same as they would if they were in a big company. We want to see...
Note that down, entrepreneurs.
Yeah, it's almost always a bad sign when somebody's paying themselves what they would make if they were in that same position in a big company. We also look at how lean they are in the beginning. So one of the metrics we look at informally with our portfolio is how much do you spend per employee? Not just on their salaries, just total spend in a year divided by the number of employees. And obviously that varies depending on do you have to travel, what kind of business it is. But if you look at it, we've got companies that are like massively lean, and we've got other ones that spend crazy amounts of money. And when we generally see people who are spending big money, it's not been great. We look for people that have, we call it an unfair advantage, but it's really just something that makes them the best person in the world or in the region to do this business at this time. So one of the great examples of that is Maria Paz Gillette from Joycar. She had an unfair advantage because she'd worked in big companies at Cencosud. She started a business that raised a bunch of venture capital, didn't go well, took a ton of lessons, and then she had connections into the insurance industry. And she was the right person at the right place in the right time to do that business. Adrian Fisher from Property Simple, his whole family's involved in real estate. So he had clients that could test it. He had people that could tell him if it was any good or not. We had Diego Caicedo from Portal Finance. He designed Portal Finance for basically his old business that didn't do well the last time the mining companies stopped working. So people that have some sort of insight into the industry of why this should be going. We look for balanced teams. So we don't want to see just two techies with nobody on the business side if the two techies are not willing to go out and try to sell. That's better than two business people with no tech. But we want to see ideally a team that's got both the business side and the tech side. We want to see just that they're good people, that they're honest, they're going to tell us that when they know something and when they don't. When I was with my second company, we did this program called Merlin Mentors in Wisconsin, where they gave us 4 different business people they would basically be our board. And one of the guys was a very experienced business leader, and he said he did it to us in the first meeting. He asked us, "Do you know such and such company?" And it was a made up company. So if you said, "Oh yeah, I know that company," to make it seem like you know what you're doing, he was
That's
like,
a good test.
"Yeah, you're full of shit." And so if you don't pass that test and you say, "Oh yeah, I know who that is," one, you've missed a chance to learn.
Yeah.
But two, it shows you'd rather look stupid or rather like be dumb than look stupid at the end of the day. We also like to see entrepreneurs that listen, but they don't follow it blindly. It's almost as bad to have an entrepreneur that never listens to anything you say to as an entrepreneur that listens to everything you say. Everything you say is a little bit better because hopefully you know what you're doing a little bit as an investor, but it's the best entrepreneurs are the ones that listen to everything you do, that everything you say, but then they take the 20 or 30% that actually is good and they filter it through their expertise because they know best. I'm going to break in real quick for a question from LinkedIn. So, how does what you look for in teams vary for different industries? So, software as a service, hardware as a service, business to government, marketplaces, and so on. The short answer is that it basically doesn't. We look for teams with characteristics that we talked about in the last segment, and really it's about finding people that we really think are going to be successful. And it doesn't, in our perspective, change from the different industries.
Now, Magma 2, what industries are you investing in? What kind of companies you're looking for? So
we invested in 32 companies with Magma 1. It was $2.5 million pre-seed and seed. So $25,000 to $75,000 checks. And then I think our biggest investment in any one company is about $300,000. With Magma 2, we're $7.5 million. And it's now 7 Chilean family offices, 2 other Latin American family offices, 4 successful entrepreneurs in the US, and 4 Chinese family offices.
Wow.
And we've refined the thesis a little bit more. So we do fintech, insurance tech, and blockchain stuff in Latin America, where Latin America is the market. And then any company with a real business model that has their tech and sales teams in Latin America, but can go to the US. And we still are investing.
Just like maintaining Magma 1 investment thesis.
Exactly. So we look for the same levels. So we would love to be the first check into companies, $25,000 and $75,000, and then we can follow on now with up to $500,000. And we can also go at a seed stage and invest a first check of $100 to $250K. Part of our goal is to be able to, in that follow-on round, be able to either lead or give the confidence to a US or Chinese fund to say, oh, these guys know what they're doing. They're on the ground in Latin America. They have connections in the US and to China. If they're going to invest another $500K, we can do $3 million because we can trust them.
Right. So as an early stage investor, like pre-seed and seed, you become more of a strategic investor for these early stage founders. So if they have you as a partner, they can go on and raise their Series Seed or Series A and eventually Series B with other institutional investors.
And the money part is important, but I think the biggest value add that we have is that we have a great team. And our team actually gets involved.
I've met some of them. Hey, regards. Saludos.
So we just have a good team that's willing to help and is.
I can testify.
they're there trying to learn and to learn with the entrepreneurs and help them grow. And we have the team from people who can help with content marketing, with public relations, with building your landing pages and doing the metrics. We have people that are experts in finance and have seen the MBA side of how do you actually run these numbers and make something that works. We have, I believe, everybody in Magma except for one person has been an entrepreneur before.
Awesome.
And I think that sets us apart, especially in Latin America. The combination of all of that with the network that Francisco and Diego bring, along with all of our Latin American family offices that want to give back and they want to be involved, and we have with 3 of our 7 Chilean family offices, we have 2 to 4 times per year they say, bring me companies, not even necessarily from Magma, that I could use in my business. I want to know what's going on. So I think there's this value add between connections to big businesses, deal flow to potential clients, all the way down to people who've been in the trenches before and can help you
really think through the issues and execute on them.
I'm going to jump in here and ask probably the second most common question after how can I get in touch with you and how can I get investment from Magma are what are the roles in Magma and how have they evolved from Magma 1 to Magma 2? So in Magma 1, I was the only full-time person. Francisco and Diego were part-time, along with one other person who helped with administration in the back office. Magma 2 is different. Now that we have a full team and are more regional, Francisco is still a part of the team and helps us make connections across Latin America. He's a key part. He's willing to make intros and sit at the table with startups, something that a vast majority of Latin American family offices are not willing to do. And this is extremely, extremely important because if you look at some of our top deals in Latin America, they wouldn't have happened without Francisco being at the table and willing to take a risk on his reputation and say, hey, this is my startup as well. Take this meeting. We added Pedro Pablo del Campo, a Chilean entrepreneur turned investor who's based in Austin, Texas, as a partner. He worked at Techstars and then joined the team as part of Magma 2. Part of his role is to be my right-hand man to look at deal flow, to do first calls with entrepreneurs, and help provide mentorship. He also helps organizing the team and providing some of the in-house services that we do at Magma Partners. Jia Hao is our Beijing-based partner. He helps companies understand the Chinese market, makes connections to Chinese companies, VCs, and government, and helps our companies take advantage of opportunities from our Beijing office. Over the last year, he's been in charge of our partnership with KR Space and 36KR and has organized events with the embassies of Latin American countries each month in Beijing and Shanghai. We also have a venture partner network that is made up of people in San Francisco, New York, Mexico City, Guadalajara, Medellin, Bogota, and Lima who help us scout deals and help with soft landings for portfolio companies. Our core team is also made up of people in our Santiago, Chile office. So Sofia is originally from the US. Angel is Chilean. He's an entrepreneur who his company didn't go as he hoped in Magma 1 and it's joined the team for Magma 2. JT is from China originally and interned with us and then stayed on the team. And Alejandra is originally from Venezuela but is based in Chile. They all work on operations and help provide services to our portfolio company. As you can see, we're a pretty international team.
In all the companies that you've invested, like what's that one reason you've invested in all these companies?
It's usually the person.
Yeah.
Do we think that they can actually build something and they're going to stick with it?
Yeah.
In an industry that we like and can provide value. That's, I would say, if you drill it all the way down, that's it.
Yeah. More than the income statement, the P&L, the metrics, the hockey stick growth, so on and so forth. Absolutely. And likewise, on the other side, like more than the money, it's the people.
Mm-hmm.
Is it okay? Maybe I've been wrong in asking those questions to my investors. Like, is it okay to ask, hey, why are you truly investing in this? Like, what are the aspects? Like, is it the product? Do you like the product so much that you're investing? Do you want to buy the product for your kids? Or, is it okay to ask? Like, entrepreneurs, I guess, in my opinion, they should ask their investors.
Yeah, it's a good point, and it's also generally a negative signal for us if they don't ask something like that. Doesn't have to be necessarily.
It's another thing to add to the list.
Yeah, why are you giving me money? But more like we almost always end all of our investor meetings saying, "What questions do you have for us?"
Yeah.
And most of the time, the entrepreneurs that don't have much to ask are not going to be the best ones. That's not always.
Even when you're hiring, like it happens to me when I'm hiring. Like, do you have any questions for us?
Yeah.
Mostly the employees who don't have questions. Yeah, absolutely. I agree. And I think that's something I have on top of the mind. This has been fantastic. Well, Nathan, thank you so much for sharing with us all these tips, the great work you're doing at Magma with your team. So many lessons learned.
Yeah, thanks for doing this. This has been fun.
Yeah.
Thanks, Komal, for all of the great questions. I'm going to jump in again here at the end and answer a couple more questions that I got from the internet. So, the most asked question between Twitter, Facebook, and LinkedIn was about dilution and cap tables. Well, for example, Daniel Morales and Andres Figueroa both asked about dilution. So they said, what's the usual stock dilution in every round, pre-seed, seed, series A, B, and C? And what percentage should a founder have after series A? It's a complicated question, and I'm going to answer it in parts. The first is that cap tables and previous dilution can be one of the biggest issues that screw up a potential investment. We've had to pass on probably 5 to 10 investments just this year that were otherwise good but had completely screwed up cap tables. So they're from either investors who invested previously that didn't know what they were doing, and maybe they invested too much money at a very high valuation because it was a family office that wasn't familiar with startups, and now they have a valuation set at $10 million when they have almost no traction, but otherwise could be a good investment or a good company that we could help. Sometimes this happens when a family member invests 50 or 100K at a really high valuation, and the founder has to go back if they want to accept a more normal VC pre-seed or seed valuation. How are they going to explain that to their family member or uncle or whoever it is that gave them the money? The other thing we see on the other side is deals where people are well-meaning, but they take advantage of the entrepreneur unknowingly. We luckily don't see many times where people actually are trying to screw an entrepreneur in Latin America. But we saw a deal this year where we ended up having to pass because the founder had sold almost 30% of their business, but they had been paying interest and they hadn't gotten it all in one. So they were getting it paid out in milestones over a couple of years. They were just getting to the point where they needed a real seed round. We asked to restructure that deal to make it more investable, but it just wasn't possible. We've also seen deals where incubators in Chile, Brazil, and Mexico have options to invest for as long as we saw one in Brazil that was a perpetual option for 10% of the company that they could invest at any time. We've seen other ones in Chile where it's common that it's 2 years, others that it's 5, where if we're investing, we can't have them have a perpetual option that could come in after us. So there's a lot of things that screw up cap tables and screw up dilution for entrepreneurs. Another one we saw was they think they had sold 50% of the business and had raised about $1 million and wanted to raise another $2 million now. And they were about to lose control of the business. The long story short there is that screwed up cap tables and screwed up dilution can screw your business and make it uninvestable for us. I don't think that there's a usual stock dilution for every round, but especially first-time entrepreneurs or entrepreneurs that are maybe for the first time going to raise money in the US or in China, structure their companies in a way that the board is set up correctly so that you don't end up with, in one extreme case, one company that we invested in had, I believe it was like 15 angel investors, and 5 were technically on the board, but the other 10 would show up to the meetings and the entrepreneur was okay with that. Other times it's a small board, but the investors have already taken over before the pre-seed round. So there's so many mistakes that founders can make in the beginning, and sometimes we can fix them, other times we can't. I could do an entire blog post and podcast just on fucked up cap tables. That's been the working title for a while. I'm going to do it eventually. So I'll just give a couple of quick rules on how we do things. What we try to do is when we invest at pre-seed, we like to be the first check-in. So we like to be $25,000 to $75,000. And we're anywhere between a half $500,000 valuation and a $2 million valuation, depending on the market, depending on the size of the business, depending on the traction. That's kind of generally the range where we are. For a Latin American seed round, we'll generally end up investing if it's our first investment in a company, somewhere between 100 and 250,000. And valuations can be anywhere from maybe $1.5 million on the really low end to as much as 5 or 6 million on the high end, depending on traction. When we do follow-ons, we can follow on with up to $500,000 if we've already done a pre-seed investment just right off the bat. And valuations are generally at least 3 million and probably higher, closer to 5 to 6 to 7 when we've done that. But it's all relative, and it depends on traction. It depends how much help you need. We haven't done any Series A deals directly out of our fund, but one thing that's really interesting is that we've been able to have, I believe now, about $6 million of follow-on funding that comes from our LPs and our network that have done follow-ons for Series A's in now, I think, about 3 companies. And that's been really, really successful. What's really helpful is if you can raise a smaller amount of money in the first couple of rounds where you're not giving up a ton of dilution, but you're still getting a motivated fund who's going to help you out going forward, you have the ability to go to the US or go to China and raise bigger Series A's or B's. Edison Acuna asked a follow-up question about equity, where he says, in a region where venture capitalists might have more experience than founders, investors might have to educate a founder on deal structure and negotiate at the same time. And he wanted to know how I see that conflict of interest and how do you make it work to align the incentives and interests on both sides so that everyone is getting a good deal. I think that, yes, it's definitely important that experienced VCs need to educate founders on deals, but it's also many less experienced investors need to be educated on deals as well. Like we talked about many of the mistakes that founders have made and investors have made on cap tables previously. But it is a potential problem where you could have an unscrupulous venture capitalist or a venture capitalist who doesn't necessarily know the best practices, structuring a deal that's not great for the entrepreneur. And so what we do is we see venture capital as a really long-term game. It's all about getting the best deals and being able to work with the best entrepreneurs. At the end of the day, we're selling money, and money is a commodity. So what are we doing that makes us not a commodity? And that's things like making sure that we don't have a conflict of interest by clearly explaining all of the pluses and minuses of the deal structures, by putting in deal terms that maybe are less VC friendly and more entrepreneur friendly off the bat, because we know that it's best for the long-term stability of the company and the long-term success. I think one thing that, especially for early stage VCs like us, is that when we don't have a big percentage of the company, where many times we're somewhere between 5 and 15% of the company, after 2 rounds of funding, we might have 15, maybe our maximum that we own in one company is about 20, is that we end up being almost in the same boat as the founder in terms of when a future investor comes in and wants to put different structure. Maybe they're asking for board seats. Maybe they're asking for other more onerous terms. So our incentives, at least in our case, are generally more aligned than you might think. One of the solutions and pieces of advice that I would give to all of the entrepreneurs listening to this and all of the entrepreneurs that maybe are looking for VC is that, one, you should always have a couple of mentors or other, could be other VCs or it could be other entrepreneurs who can take a look at a term sheet or a deal structure and say, hey, yeah, this is normal and this isn't. That's one thing that I've done for different entrepreneurs that either don't fit our investment thesis, or it wasn't the right time, or their later stage, where we're just happy to look at a term sheet or the overall outline of a deal and give feedback. And we've helped entrepreneurs make deals a lot more entrepreneur friendly for them just by
knowing which questions to ask and highlighting which things are fair and normal and which things are not normal for an investor to ask for. If you're an entrepreneur and you're looking at doing a deal, whether it's with an angel investor or a later stage fund, feel free to reach out to us and ask any questions about your term sheet or just the structure of a potential deal or things that you might want to ask. We will be in 2019 open sourcing some more of our term sheets. You can find some of the examples on our blog, magmapartners.com already, but we're going to be doing a little more detailed dive into what should and shouldn't be in one of these pre-seed and seed term sheets. Gabriel Martinez asked a really good question about how do we decide which startups work with closely in our portfolio. So he says, on which parameters of the businesses do you actually intervene as an activist investor? Where are you more passive in the fact that between 8 and 9 of 10 startups won't play a huge role in fund return? So how do we differentiate management of less and more successful investments? It's a really good question. And the way we look at it is that we'll work with any startup, whether they're successful or not successful, as much as the founder wants us to and listens. So I talked about earlier in the podcast that it's almost as bad for a founder to listen to 100% of what we say than to listen to 0% of what we say. The best are the ones that listen to everything, but then only keep maybe 20 or 30% of the best stuff and then make the rest of the decisions on their own using our advice. But there's many founders who you give them advice for 6 months, 1 year, 2 years, and they never follow it. And they don't have a good reason for not following it. And it's like talking to a wall. Those are the types of founders that we end up doing the sort of minimum work with, even if they are really successful, just because there's not much we're adding. And it's not worth anyone's time to have the same conversation for 3 years. On the other hand, we've worked with multiple founders that have built good medium and small businesses that will never provide huge fund returns, but they're fun to work with. They're still working on projects that they really enjoy, and they're building good businesses, and happy to spend time with them as much as we spend with some of the top companies that will provide multiple X returns of probably the whole fund. So from my perspective, it's really about, is the entrepreneur willing to have a relationship where it's give and take? Even if they reject everything that we say, there's a good reason for rejecting it and they think it through. In terms of intervening as an activist investor, there's not all that much we can do since we're an early stage fund. So if the founder doesn't want us to play a role in the company, we basically can't play a role in the company, because we try to create founder-friendly deals so that they'll be successful going forward. We can do different things to make our opinions known and point them in the right direction, or what we think is the right direction. But at the end of the day, there's not all that much we can do if the entrepreneur doesn't want us to help. In a couple of different cases, we've gotten very involved in businesses where we could provide value and the entrepreneur wanted us. One example that I talked about with Adrian Fisher on Property Simple was in 2015, when Property Simple was making the jump from Propiedad Fácil in Chile to Property Simple in California. I went with him and spent about 3 months in California, and then drove cross country from San Francisco to LA to Phoenix to Dallas, Chicago, Madison, New York, and other places in between, meeting with potential clients and then also meeting with investors to really see if his business had potential to make the jump from Chile to the U.S. I've jumped in on Joycar when needed. I've jumped in on Portal Finance when needed, spending big chunks of time with companies that have asked for it and also where we have a bunch of upside. I'm totally willing to do that, and the team is willing to do that, and it's something that I think probably sets us apart. We're all entrepreneurs and have been in the trenches and want to be in the trenches again. It's part of the fun of having a fund. It's being able to see from the from the trenches what's going on in all these different industries in all these different countries across Latin America. Thanks again for listening to this episode of Crossing Borders. I think that it was a really interesting episode to be able to have the conversation with Komal. So thanks again for doing that. I really liked the questions and led us down a really interesting path. I think it was an interesting experiment to intersperse some extra commentary with questions from the internet. Thanks to everybody who asked questions on Facebook, LinkedIn, and Twitter, and also via email and WhatsApp. Really appreciate it. I think that it definitely added to it. If you have more questions that I can answer on deal flow, on term sheets, on how do we actually make investments, what does our team look for, please feel free to reach out in the comments on my blog, nathanlustig.com. Send us an email via Magma Partners or reach out on any of those social media. If you think that a founder or an investor or anybody in the Latin America region would enjoy listening to this podcast and hearing some of the tips and tricks that we've learned over the last 5 years with Magma Partners, please share with them. It's the best way to get knowledge about the ecosystem out to the people who need it most. Please check the show notes for some links to some of the things that we talked about and the people who asked questions. Thanks again for listening, and I hope you have a great rest of your day.